Welcome to Efficient Tax's video on tax loss harvesting. We're going to identify the hidden value in losses while guiding investors when to realize a loss and how to optimally use any realized losses. In this video, you're going to learn what is tax loss harvesting, the hidden values of losses, when to sell a loss, and when to use losses against gains to their maximum advantage. By the time this video is over, you will understand your investment decision options available when tax lots have losses, and also how to harvest any losses to capture their highest value. Let's start with what is tax loss harvesting. Tax loss harvesting is the process of determining when to realize losses and then when to allocate losses against taxable investment gains. Efficient Tax uses the hidden value in losses and guides investors how to optimally use any losses. We want to quickly define for you the Efficient Tax view of the after-tax economics for both a profitable and losing position. The after-tax value of a profitable position equals its market value minus its tax liability, while the after-tax value of a losing position is the market value of a tax lot plus any cash savings from not having to pay taxes on a profitable position. The flip side of the government taking a piece of any profits is that it absorbs part of a loss. If an investor makes more money than they lose over time, they will always be able to save on taxes through the harvesting of any realized losses. Now that you have the definition of tax loss harvesting, we're going to go through an example to help increase your understanding. This example, along with the explanation after, will explain some of the hidden values of tax loss harvesting. Let's use an example of a stock purchased for $10 a share, then sold for $20 a share while in the 40% tax bracket. A $10 profit subject to a 40% tax generates $4 in taxes. Therefore, the after-tax proceeds is the $20 per share market value less the $4 in tax, or rather $16 in after-tax value left for the investor. Now let's look at a stock that is underwater. Let's say an investor purchased a stock for $20 a share and later sells it for $10 while burdened in a 40% tax bracket. Some might say the investor would only wind up with the $10 price they received in the market when they sold it, since the stock was a loss, correct? Actually, Efficient Tax calculates it differently. The investor has the $10 that is left, plus $4 in taxes the investor will save by being able to avoid paying a tax liability on another profitable investment that has a deferred tax liability that isn't due until the investment is sold. But because of losses available for tax loss harvesting, the tax liability that might be due on some of the shares in a profitable tax lot will not have to be paid. If an investor has 100 shares of a stock and only enough losses to sell 22 shares and pay no tax, then just sell 22 shares. Once a tax savings is realized when a loss is allocated against the sale of a profitable investment, it leads, in the example described, to $14 in after-tax proceeds available to reinvest instead of only $10. And we shouldn't worry so much about realizing a loss when there isn't a fully valued profitable stock available right away to offset it against and pay no tax, as market volatility usually offers those opportunities on an ongoing basis. Efficient Tax does all the mathematics necessary to fully understand the fundamental break-even economics of each tax lot. Sensitive to cost basis, tax rates, time, and relative performance expectations, it will calculate the after-tax value of a losing investment and compare it to its forecasted after-tax value in order to assess the remaining after-tax dollar return potential of a losing position. A loss should be realized when the extra after-tax value forecasted by holding onto a tax lot by comparing its current after-tax value against a forecasted one is measurably less than the amount of after-tax value that can be generated by reinvesting the tax lot's after-tax value at a reasonable forecasted rate of return with its tax consequences taken into account. In the end, a loss is harvested to its fullest value by offsetting losses against profitable investments that are the most fully valued, giving up the least in terms of future performance. Now we'll look at a graph to find out the best time to sell an underwater investment. This blue line is the forecasted before-tax value of a held tax lot over an additional 4-year investment horizon in this example. Now we add the yellow after-tax equivalent line of the existing tax lot should it be held out to the end of a chosen investment horizon. The after-tax value of an investment is between its purchase price and current market value. In the case of a profitable investment, the after-tax value is below the market value. However, with a losing investment, its after-tax value is still between its purchase price and the market value. But in this case, the after-tax value is above the market value because of the tax savings value of the loss. Looking at the yellow line, there is a step down in after-tax value once it achieves the lower tax-rated long-term tax status. This is because if we sell during the higher short-term tax-burdened rate window, we can offset and avoid a higher tax liability embedded in an overvalued short-term holding. A realized short-term loss that avoids a $40 tax on a $100 short-term capital gain is significantly more valuable than a long-term loss that avoids a $20 tax on a long-term capital gain. The new green line now represents the after-tax value over time should an investor sell a stock in the short-term window and reinvest any after-tax proceeds over an investment horizon inclusive of any tax savings. This is a better investment decision choice than waiting to sell until the long-term window is reached, represented by the purple line, because any losses realized would normally only be available to offset and avoid a lower long-term tax-rated realized gain. The hidden tax savings value of a short-term loss is more valuable than the hidden tax savings value of a long-term loss. We, of course, would prefer owning stocks with gains as opposed to losses, and even though it might initially seem counterintuitive, the same stock at a current price with a profit and a tax liability embedded has a lower after-tax value than the same stock at the same price with an unrealized loss because of the tax savings value of the loss. In the end, the highest value to be achieved from a tax loss harvesting process would be the combination of selling a losing position that is the most overvalued and then selling a profitable position that is also the most overvalued, whereby both sets of market proceeds upon sale can be reinvested in better investments without any taxes being paid. Efficient Tax Portfolio Optimizer maximizes that opportunity across entire portfolios. The only unknown in the application of efficient tax is any uncertainty about stock price and performance forecasting. The rest is just mathematical consequences. If we knew future prices, there would be no risk. We know, of course, that every stock price forecast has some degree of error. More unpredictable earnings usually have higher betas. But it might be the case that an investor sells an overvalued position in Coca-Cola at a loss and also sells an overvalued Pepsi at a profit and pays no tax, and is able to redeploy the entire market value of both stocks at higher forecasted rates of return, without taking any more measurable risk, as the forecast uncertainty about Coke is probably about equal to the uncertainty about Pepsi. Now let's take a look at when a loss should be realized if a stock with a loss has already been held more than 12 months. In this example, we can see that a sale at a loss would be recommended because the after-tax proceeds from selling the losing position can be redeployed and earn greater after-tax wealth over time, rather than holding on to the existing tax lot with its remaining return potential. All based upon each tax lot's cost basis, date of purchase, investment horizon chosen, and forecasts the investor views as reasonable. A stock with a profit requires a higher rate of return on a reinvestment on any after-tax proceeds upon sale than is available from an existing holding in order to recoup any tax cost over time. Alternatively, selling a stock with a loss can be justified even if the existing investment has a higher rate of return potential than a reinvestment because of the higher after-tax proceeds than can be reinvested due to the tax savings being able to be reinvested. Now, let's take a look at when selling at least part of an individual profitable short-term tax lot makes sense, only because there are losses available to harvest against a gain. This is because the after-tax proceeds, being the full market value of the stock due to no tax needed to be paid, can be reinvested at a higher rate of return than is remaining from an existing investment. In this case, you can see the Sell Now green line has a higher after-tax wealth accumulation value than the hold option. In this situation, the picture depicts that the cost basis equals the market value, resulting in no tax to be paid on a number of profitable shares to be sold. In the efficient tax loss harvesting process, the picture displayed shows the impacts of selling a profitable investment and paying no tax, as if the cost basis equals the market value, for as many shares of a tax lot that may be sold without any tax being due, as a result of losses being available for harvesting purposes. The graph results chart shows how many shares can be sold without any taxes being paid as a result of enough losses being available to offset the gains on that number of shares. If a stock has $10 in short-term profit on each of the 100 shares owned, and there are $255 in short-term realized losses, then only 25 full shares can be sold without paying any taxes, utilizing $250 of the $255 in realized short-term losses. If an investor at the very end of the calendar year has more realized long-term losses than realized long-term gains, then the tax rules allow that these residual long-term losses may alternatively be harvested against any extra realized short-term gains over realized short-term losses, where the hidden value of the long-term loss is raised because of its potential of avoiding the greater tax liability associated with a short-term gain as opposed to a long-term gain. Alternatively, a short-term realized loss that is harvested against a realized long-term gain captures less hidden value than if it were harvested against a realized short-term gain, and should only be done if the investor is willing to give up some hidden tax savings value in order to reduce a current tax liability, even though it might cost the investor in future after-tax wealth accumulation. Again, the graph will only relate to the number of shares able to be sold of a tax lot due to a loss harvesting process without any taxes needing to be paid. The efficient tax results graph simulates that no taxes would be due upon the sale of a number of shares of a profitable tax lot by raising their cost basis to market value, resulting in no profit to pay tax on for as many shares as there are enough losses to do this. The graph results set indicates both how many shares may be sold of a profitable tax lot utilizing either matched or alternate losses available for harvesting as the final trades of the year. This cost basis mark-to-market value adjustment due to tax loss harvesting is displayed whether realized short-term losses are matched and harvested against realized short-term gains, realized long-term losses are matched and harvested against realized long-term gains, or whether an end-of-year alternate share tax loss harvesting process short-term losses are harvested against long-term gains, in an effort to lower current tax liabilities even at the cost of reducing the hidden value of a short-term loss, or by offsetting a long-term loss against a short-term gain, magnifying the hidden value of a long-term loss. Clicking the Rerun Analysis Using Alternate Shares button on the results screen should only be done at the very end of the year for an investor's last trades of the year, and should be used with caution, as an investor doesn't want to be in a position where they sold a short-term gain believing there are long-term losses available for harvesting, and then utilize the long-term losses against an additional sale of a long-term gain. thereby exposing the investor to having sold a short-term gain, thinking no short-term taxes would be due, only to discover that the long-term losses were subsequently used to harvest long-term gains. In an efficient tax portfolio optimizer cell ranking process, the hidden loss values are used to their maximum value by utilizing losses first against profitable tax lots where the greatest excess return, or alpha, is available through a sale and reinvestment versus holding on to a profitable tax lot. If Efficient Tax calculates that the investor would be better off by selling rather than holding an underwater tax lot on an after-tax basis, then the investor should consider selling. This has been a quick overview of the tax impacts from tax loss harvesting. Over the past several minutes, you have learned what is tax loss harvesting, the hidden values of losses, when to sell at a loss, and when to use losses against gains to their maximum advantage. Tax loss harvesting holds enormous value for investors. Efficient Tax fully harnesses that value for our users. We appreciate that these concepts are likely new to you, with a lot of moving parts. We might suggest that you view this video again because of the importance that proper tax loss harvesting can have on after-tax wealth generation and because of its complexity. Thank you again for your interest in learning more about Efficient Tax and tax loss harvesting. We invite you to learn more about Efficient Tax and Efficient Tax Portfolio Optimizer by watching additional videos and by reviewing our other education offerings in our education library. Thank you again for watching, and good luck in the markets.